One of the things that makes planning for retirement so difficult is that all these different types of accounts that you have put your money in over your working career, they all have different tax implications. And that's one of the most common ways we see people mess up when planning for their retirement, is not understanding all of the tax implications or tax advantages that comes with these accounts. In this video, we're going to give you a short overview about some of the things we see when planning for retirement and dealing with these account types that could be maximized in your situation. Hi, I'm Logan Sadler. I wanted to say thank you for joining us for this video series, the Financial Beat video series. Some of you guys have either heard us on the radio or came to one of our events in the past. And this is going to be a very educational format. We're going to do each week with new videos just like this one to give you guys the most up-to-date information and really keep these more educational. For those of you that are like myself, where you're more visual, this is going to be a great video series for you to stay on top with, and click subscribe below to get all of the new updates that you're going to get. Again, every week we're going to be coming out with new videos just like this one. And today's video, the top of mind when we're dealing with this type of video is, so many of you guys are asking questions about Roth IRAs, taxable accounts, tax deferred. And that's exactly what this video is for and what we're gonna go over in it. So, as many of you know, there's many different ways to pay taxes, right? Why I said many different ways is because, of course, at the end of the day, you have to pay taxes in one form or another. Right? There's capital gains, there's ordinary income, there's a lot of these other ways to structure the way you want to pay taxes. So again, we're going to talk about some of the three vehicles or the three ways that most people end up paying taxes. The first one is tax now. Those of you guys listening that have had a brokerage account in the past or had cash and you just put it into the market, that is what's called a tax now vehicle. How it works is that's one of the buckets where tax nows can be mutual funds, stocks, bonds. When you're buying and selling those, they're typically taxed at a capital gain, capital loss, long-term gain, short-term loss, right? You get to kind of control when you're taxed on those when you make a sell. And so those are one of the more tax efficient ways where you do have a little bit more control in the short term on those vehicles. And they also could be in things like CDs, a few other types of savings accounts are taxed now. So there's a lot of different forms of that. So that's category tax now, okay? Then a lot of you, most of you have probably heard of is what's called tax deferred, okay? That could actually be traditionally annuities are what's called a tax deferred vehicle. I could put $100,000 into that investment. As it grows, I don't have to pay any taxes on it until the end date when I begin to withdraw, and it's all taxed at ordinary income, okay? And the other most popular form of what's called the tax deferred vehicle, and this might hit a lot of notes with a lot of you viewers, is the 401ks. 401ks, traditional IRAs, those are all what's called tax deferred vehicles, meaning you're getting a tax break now as you're putting money into those vehicles, and they're gonna grow at a tax deferred rate. So when you begin to withdraw, they now become taxable at ordinary income. So not a lot of huge tax advantages to those in the long term. There's not a lot of different things you can do with tax deferred vehicles other than take them out at what's called ordinary income. Ordinary income versus what we talked about a little bit ago, capital gains. Ordinary income tends to be a higher tax than what a capital gain would be. So that's why we like to say is it's important to have a couple different mixes. The third bucket we're going to talk about, okay, this might be one that you guys have been wanting to learn about or maybe have heard about. That is tax-free, okay? When I say tax-free, I always joke because I typically get pretty happy when talking about tax-free. What tax-free means is there's only a few ways to get those. One of the two most popular ones is cash value life insurance, okay? So cash value life insurance builds a death benefit, and it also builds a cash value to where if you begin to withdraw funds, it's tax-free, okay? The next way that's, again, one of the more popular ways now is what's called the Roth IRA. Okay, the Roth IRA, do you remember the IRA? If you put away money every year into that account or the 401k, you got a deduction on your income, right? So if you made $100,000 that year and you put $10,000 in the traditional account, your income would be now deducted that $10,000 that you put in. The Roth IRA, you get no tax advantages on it right now, but in the future, when you begin withdrawing them, instead of paying capital gains or ordinary income, you pay zero tax on the withdrawals from a Roth 401k. So, as a financial advisor, I could only tell you guys the most beneficial part about investment and retirement planning, where I see a lot of clients not mess up, but really not make the best decision for them at times, is not understanding the tax implications that each of these accounts have on you at different stages of your life, right? There's different ways to take advantage of tax breaks now, while also still having some tax control throughout your retirement. That's where you'll see us, and we'll do more videos on things like Roth conversions and stuff and things of that sort. But the most important thing is to realize when you are building a financial plan, it is really important. You've heard diversification. What's really important is that's not just stocks and bonds. What a real good financial plan has is tax diversification. So you want to have things in taxable investments to where if you needed to have some tax favors on long-term gains or short-term gains, you have advantages to where you can access that bucket of cash. You also want to have tax-deferred vehicles that aren't killing you every year on interest earned or things like that, to where you could defer the taxes till later and have more control down the road. And you always want to try to mix in, if it's possible for you, the Roth conversion or a Roth IRA. Those are two of the biggest components. Having those three different forms of taxes when you begin to withdraw money in retirement is going to be very, very efficient to have three different buckets to pull from. Okay, and again, that's one of the things I've noticed meeting with thousands of people throughout the years, is making sure that you understand the importance and the differences between how Uncle Sam lets you pay taxes on your money. Okay, like I said, lets you because you do have a choice in the matter, and one of those accounts isn't right for everybody, or not everybody should have all three. Again, it really comes down to your individual situation, but that was just a really good overview of how some of the tax implications on the accounts that a lot of you watching this video might have or might have had questions on. Again, click subscribe. We're going to be doing videos like this each week. The Financial Beat YouTube channel is here to stay, and we're very excited. I look forward to bringing another video to you guys next week. Talk to you soon.